Investors should be ready for a U.S. recession in 2023, analysts say. Geopolitical tensions, energy market imbalances, persistently high inflation numbers, and rising interest rates have many investors and economists concerned that a U.S. recession is inevitable in 2023. Recession risk has been rising throughout 2022 as the Federal Reserve has raised interest rates in its ongoing battle against inflation. The good news for investors is that the U.S. economy has remained relatively strong up to this point. Unfortunately, the higher interest rates rise, the less likely the Fed will be able to navigate a so-called soft landing for the economy in 2023. Economic recessions are no reason for panic and have been a regular occurrence over the past century. However, investors can make the most of a difficult situation by knowing which risk factors to watch and how to position their portfolios to optimize their performance if a recession is looming in 2023. 2023 recession risk factors. Will there be a recession in 2023? What to invest in during a recession? 2023 recession risk factors. Many factors can trigger or contribute to a recession. But there's no question that two specific factors are the biggest risk to economic stability in 2023. Any investor who hasn't been living under a rock for the past year is already aware that the primary economic risk factor heading into 2023 is inflation. In June 2022, the Consumer Price Index gained 9.1% year over year, its highest inflation reading in more than 40 years. The Federal Reserve has taken an aggressive approach to combat inflation. But the best solution to the inflation problem is also the second major economic risk factor in 2023. Higher interest rates. Higher interest rates increase the cost of borrowing money, discouraging companies from taking on debt to invest in expanding their businesses. Higher rates also reduce consumer spending, easing demand pressures that have contributed to rising prices. Starting in March 2022, the Federal Reserve began implementing a series of aggressive interest rate hikes to target inflation. So far, the Fed has raised its Fed funds target rate range from essentially zero to its current range of between 3.75% and 4%. Fortunately, the latest CPI reading in October showed 7.7% year-over-year inflation, significantly down from the 9.1% peak in June. However, 7.7% inflation is still well above the Fed's long-term target of 2%, so interest rates will likely be heading even higher in the coming months. To make matters worse, the ongoing conflict between Russia and Ukraine has created uncertainty in the global energy market, particularly in Europe. Nations in the bloc will likely have to make do without Russian natural gas this winter, and a potential oil and gas price shock in the coming months could tank an already fragile U.S. economy. Will there be a recession in 2023? Inflation and rising rates have not yet dragged down the U.S. economy. In fact, the U.S. economy added 261,000 jobs in October, and the U.S. unemployment rate remains historically low at just 3.7%. Investors should continue to monitor the labor market as interest rates rise. The bond market is currently pricing in a 61.5% chance that the Fed will raise interest rates by at least another 1.25 percentage points by June 2023, bringing its target rate up to at least 5% to 5.25%, according to the CME FedWatch tool. Bank of America chief U.S. economist Michael Gapin says two more 0.5 percentage point interest rate hikes in December and February, followed by an additional 0.25 percentage point rate hike in March, will likely tip the U.S. economy into a recession. We expect a mild recession in 1 key to 3 key 23, Gapin says. With the Fed hiking to 5% to 5.25% in our forecast, history suggests a soft landing is unlikely. Fortunately, Gapin expects conditions to improve enough for the Fed to begin cutting interest rates again starting in December 2023. Despite the near-term economic headwinds, Goldman Sachs chief economist Jan Hatzius is optimistic that the U.S. can stave off a recession in 2023. The U.S. should narrowly avoid recession as core, personal consumption expenditures. Inflation slows from 5% now to 3% in late 2023, with a 0.5 percentage point rise in the unemployment rate, Hatzius says. Fed monetary tightening is certainly weighing on economic growth, but Goldman projects that real U.S. disposable income will grow at least 3% over the next year. While there are risks on both sides, we think the real income upturn is likely to be the stronger force as we move through 2023, especially because the financial conditions drag will likely diminish assuming Fed officials do not deliver dramatically more tightening than the rates the market is currently pricing, Hatzius says. What to invest in during a recession? There are several general strategies investors can use to manage risk and take advantage of opportunities during a recession. First, consider reducing exposure to volatile stocks and increasing cash holdings. Cash may not be the most exciting play, but it reduces market risk and provides financial flexibility if a recession creates potential buying opportunities in 2023. In addition, investors can earn 3% interest or higher in an online savings account right now, and those rates will only continue to rise if the Fed issues more rate hikes. In addition, value stocks have historically outperformed growth stocks during periods of elevated interest rates. Higher interest rates harm companies' discounted cash flow valuations, which can hurt high-growth stocks. For example, in the past 12 months, Vanguard Value ETF, ticker VTTV, has generated a total return of 2.8% as of November 25, while Vanguard Growth ETF, VUG, has lost 28.4%. Finally, certain stocks and market sectors are more defensive than others and tend to outperform the rest of the market during recessions. Utility stocks, healthcare stocks, and consumer staples stocks are considered defensive investments because their earnings tend to be insulated from economic cycles and swings in consumer confidence. In addition, certain individual stocks have outperformed during each of the past 2 U.S. recessions. Walmart Incorporated, WMT, Abbott Laboratories, ABT, and Home Depot Incorporated, HD, are just 3 examples of stocks that beat the S&P 500 in both 2008 and 2020. Callie Cox, U.S. investment analyst at eToro, says investors should also take advantage of a potential recession in 2023 and prepare their portfolios for the light at the end of the tunnel in 2024 and beyond. Markets look ahead, and that means you could benefit from looking ahead to the next cycle when it comes to your portfolio, Cox says. Think about what sectors do well early on in an economic recovery: financials, real estate, and technology. Investors can take a diversified approach to these 3 market sectors by buying S&P 500 sector exchange-traded funds, or ETFs, such as the Financial Select Sector SPDR Fund, XLF, Real Estate Select Sector SPDR Fund, XLRE, and the Technology Select Sector SPDR Fund, XLK. Make sure you stay watching our next related video to discover more amazing videos, and also subscribe to our YouTube channel and leave a like on the video. If you have any comments, please leave them in the comments box below. Thank you very much for watching, and I will see you in the next video.